When executives look at a company's bottom line, they see the final score. But to evaluate the internal managers who actually run the business, overseeing distinct cost, revenue, and profit centers, that aggregate number is useless. A performance metric has value only if it maps directly to a manager's true locus of control. There must be a strict cause and effect relationship between the financial outcome we measure and the specific decisions that manager makes. If a metric is influenced by external market forces or corporate overhead that the manager cannot change, the feedback loop breaks. You end up penalizing or rewarding them for the actions of someone else. Metrics that include uncontrollable variables distort the data. They strip management of the ability to make rational decisions about where to deploy resources. In many departments, the math is straightforward. Cost centers and revenue centers are environments where a manager dictates only one side of the financial equation. They either minimize expenses or maximize sales. Because the manager influences only one type of factor, variance analysis, comparing actual results against a budgeted benchmark, is the appropriate tool to measure their performance. These drivers don't even have to be strictly financial. A cost center manager's performance could be tracked by the number of invoices their team processes per hour, or the percentage of customer shipments filled correctly. But the equation changes in a profit center. Here, a single manager sits at the intersection of both incoming revenue and outgoing costs. Simple variance analysis breaks down in this environment. It cannot accurately isolate a manager's impact when they are simultaneously adjusting pricing, volume, and production expenses to optimize their specific unit. To evaluate a profit center, analysts must move past standard accounting models and use a different analytical lens. A profitable corporate income statement can be misleading. A strong aggregate bottom line often acts as camouflage, obscuring critical failures happening at the individual unit level. To find those failures, analysts isolate what is known as a segment. This is any distinct subunit, a specific product line, a geographical territory, or a particular customer base that requires isolated evaluation. General corporate overhead is a constant threat to these evaluations. When companies spread expenses like headquarters rent or executive salaries across every segment, they distort the unit's actual financial health. Discovering true profitability requires breaking the aggregate financial statement into a structured, tiered model. This is the segment margin income statement. It is designed to isolate variables and assign accountability by breaking the statement into specific levels of margin. First, we subtract variable production and variable selling and administrative expenses from sales. This establishes the baseline, a $90,000 contribution margin. Next, the statement separates fixed costs into two categories of accountability, controllable and traceable. We isolate the fixed costs that the segment manager directly dictates, like local advertising or unit-specific salaries. Deducting these reveals the short-run performance margin, which in this case is $35,000. Finally, we deduct traceable fixed costs. These are expenses tied exclusively to the segment, like equipment depreciation, which exist even if they are outside the manager's immediate day-to-day control. This yields the final segment margin of $20,000. By stripping away general corporate noise, the resulting segment margin isolates the financial effects of a manager's choices regarding their specific business unit. Applying segment margin logic to customer profitability reveals how misidentifying the source of a loss can lead to irreversible strategic errors. This chart breaks down a customer portfolio. On the surface, two distinct clients appear to be losing the company money. Looking at the bottom line operating income, the accounts for Gonzalez and Kawanishi show losses of $200 and $2,400, respectively. The common executive reflex is to drop both unprofitable customers immediately to protect the company's overall margin. But that reflex is based on a flawed premise. Operating income contains allocated fixed costs, which often corrupt unit-level decision-making. If we apply segment margin logic and isolate the Kawanishi account, we see a negative customer margin of $200. In this case, dropping the customer is correct. Kawanishi is failing to generate enough revenue to even cover their own direct variable costs. But the Gonzalez account presents a different mathematical reality. Their customer margin is actually a positive $1,800. Gonzalez's negative operating income is an illusion. It is created entirely by the assignment of $2,000 in generalized allocated fixed costs. This is the allocation trap. Dropping Gonzalez does not eliminate that $2,000 of corporate overhead, it merely shifts the burden onto the remaining profitable clients. This redistribution creates a cycle. It artificially lowers the margins of healthy segments, making them look like candidates for further cuts. Corporate accountability requires exact cost measurement. Mastering the segment margin approach allows a company to distinguish between actual losses and allocated noise, protecting it from cannibalizing its own profitability.